Check, please.
Hey, welcome back to Everything Money. It is Seth, Paul, and Mo. We're talking today about dividends. There's a lot of great dividend investors out there. People love it. There are whole channels dedicated to this, Paul. We talked about Coca-Cola of late. Some people are confused about the idea of what a dividend is, including myself at times. I don't actively look at my account every day, and maybe you do, maybe you don't. But every once in a while, you get a
check,
a
wire,
and it feels good. You're not an overly excited.
I love dividends.
Go on.
No, go ahead. What were you going to say?
Well, you're not overly excited about them. Some people are incredibly passionate about these things. And
I actually love dividends a lot.
Oh, okay. Because I think you usually, in my mind, and Mo as well, the dividends for us is kind of like taxes. They just kind of happen, and we're not going to center our mind around them. But I'd love to get an explanation from you and for our viewers at home, like the process of how a company gets a dividend, how you should feel in getting one. Are they inefficient, tax inefficient for the company, for the user? Go at it, Paul.
So one thing I want to ask Mo about. Mo, 2 years ago, what was your view on dividends?
I wanted to collect them.
Yeah, why?
Because I want the cash flow.
I agree, and I still am the same way today.
Yeah.
I like getting the cash in, but I want everybody to remember, just because you like something doesn't mean it's the best thing for you. Because remember, just like us liking dividends, the public likes dividends. So what companies will do a lot is if their stock is stagnant, they'll increase their dividends. Well, how do you increase your dividend? How do you pay your dividends?
You got to have more cash flow, right?
More cash flow, or take on debt.
Or borrow.
Correct.
They do that? They'll sell off shares or borrow?
Because guess what? How many people are actually looking at it going, can they afford the dividend? And Seth, one of the first things you always said to me is,
sure.
Paul, one of the things I learned from you is the dividend isn't always safe.
Yeah, it just seems like it's a static number that never changes, and people really grasp that. We've done some videos in the past about that GEO group, that jail cell group, and they had a massive fallout because they can't afford their dividend. They cut it. AT&T got in trouble as one of the most famous dividend stocks out there. Just recently, when they merged with Discovery, they're pulling back their dividend. People are upset. So go on, Paul.
So, anecdotal story. 18 years ago, I was getting into real estate. I found a real estate attorney. We went and met. I said, well, what do you do? He's like, well, I actually handle trusts as well. I'm like, oh, he's like, yeah, so I'm responsible for generating income for the trust. I'm like, well, how do you do that? He goes, through dividend stocks. I said, okay, like what? He's like I bought GM. And I remember being like, GM struggles so hard to make money. He goes, yeah, but they pay a 5% dividend, whatever it was at the time. And sure enough, years later, they couldn't afford the dividend. I think it was very close after they couldn't afford the dividend. They went bankrupt. I look at it saying, people have a misunderstanding of dividends. So when we look at a company, let's look at example Walgreens. We just did a video on Walgreens. Walgreens is paying a massive dividend, 4.1%. The S&P 500 is paying like 1.3%. So this is over triple what the S&P is paying.
Mm-hmm.
But look at this. Their 5-year average free cash flow is $5.3 billion. Their dividends paid, $1.7 billion. They can easily afford that dividend. I am not worried about them cutting that dividend. Right? And that's what's important to me. Before you go out there and get excited about these high dividend rates, remember, a lot of times companies keep the high dividend rate to get people to buy the stock. Because if they buy the stock, they're like, oh, I see this high dividend. I'm making 6, 7, 8, 9, 10%. It's called a dividend trap. So the first order of business that I want to explain in this video is don't fall for the dividend trap. Make sure they can afford it. Most people look at earnings. I don't look at earnings. I look at free cash flow. And in our software here that you can get in the link below, it shows you the free cash flow average for the last 5 years. Make sure they can easily afford that dividend. Because the last thing you want to do is buy a company because of this dividend, they cut it. What do you think is going to happen to the stock price?
It's going to fall.
It's going to plummet. Because people are going to say, I don't like that anymore, and they're going to sell. Is it justifiable? I don't know. So the first things first is make sure the dividend is sustainable.
Yeah.
Okay. Second thing. What was that, Mo?
And don't necessarily, Paul's going to get into it, but don't buy a company just for the dividend.
I think that happens a lot, Paul.
It happens a ton, Seth.
And I use the analogy all the time. It's if you want a cherry, go buy a cherry. Don't go and buy the ice cream sundae just to get the cherry on top.
Oh, that's a great analogy. I never even thought about that.
Yeah, it really doesn't. That's how I look at it. And I'm like, I don't understand why you're going to buy all of this when you just want this.
And the ice cream sundae might have expired ice cream. Correct. Or whatever it is. It's just, guys, focus on what you're trying to do. So next thing, this is Walgreens. So every company out there, if you look at their income statement, there's a number here called net income. People don't pay attention to is the line 2 above it, provision for income taxes. This net income number is after taxes, not before. It's after. When When they get this money in, it's after they've paid their tax. So it's in their bank account. They can buy back shares, they can pay down debt, they can make acquisitions and not pay any extra tax. Here is why dividends are very tax inefficient. The second they issue you a check, this is what always bothers me, and I'm not trying to get too political, but when people say, oh, we need to tax people more because when they get that dividend income, they're paying such a low rate. Guys, it's a double taxation. Because the second they issue a dividend to you, you're being taxed again. A second time.
What's the first time? Oh,
When
the company was
money.
taxed.
Because you own part of the company.
Oh my
So your
gosh,
share
Paul,
of the
you're
profit is
kidding.
being taxed already.
I see.
That's the issue we have, guys. I'm looking at it saying, okay, if you can get a tax efficient way of increasing your shares in a business, that would be by buying back shares. Paying down debt would increase your equity in a business. Making acquisitions could help grow the business. The tax inefficient way is paying out dividends because they already paid this tax once. It comes to you. Let's say they paid all this out in dividends. You're going to pay another 30% in there. So your $2.3 billion now becomes $1.6 billion. If they kept it within the company, it stays at 2.3. They can use that full 2.3 to grow the business, buy back shares, pay down debt.
And thus helping you as a stockholder.
Correct.
I did not know all this.
This is, again, I like dividends because I like getting that check for some reason, but it's not tax efficient. But if I have a big company, I'd rather have them buying back shares and increasing my share of the company. But it is nice to get that check every month.
What about a company like AT&T that Mo would call a dinosaur that never goes anywhere, but people really love just
That's why when we did an AT&T video, go look at our past videos, what did we say, Mel? We wanted them to pay down debt.
We want them to pay down debt and buy back shares.
And buy back shares. We didn't want them paying that 7% dividend.
That move that they made of cutting their dividend was a step in the right direction to me. It pissed a lot of people off, but to me, that was a step in the right direction.
So dividends can be, especially if you're older, you get the income, you can live off it. I get that. But remember, it's not the tax efficient way to do things. And I'm okay with that. Because to me, it's like, hey, listen, as long as you know you're paying that dividend, great. And for those of you out there who talk about tax policy, just remember they've already been taxed once before. So when they say, oh, they're getting away with a lower tax rate, no, they're actually paying a higher tax rate. Because if the corporate tax is 35%, then you pay another 30% when it comes to you. You're essentially getting rid of almost 60% of your tax of your profit by paying out dividends.
So, Paul, with all this said, we do get comments in our community about reinvesting these dividends. So do we take them out, cash them, and love them, or do we put them back in? A common question. What do you think?
I'm a big believer in every dollar that gets taken in needs to be evaluated on where we want to put it. So I personally do not just do a dividend reinvestment. I don't buy unless it's an ETF. If it's an ETF like SPY and it's part of my strategy of saving for the long run, I would do that. But for an individual company, give me the cash, let me accumulate my cash, and then when I have an appropriate amount, find the stocks I want to buy and buy more of them. It could be the same company, could be a different company. It's all based on valuations. But it's a great question. And for ETFs, I think it's a little more important to reinvest if it's part of a long-term strategy of saving to retirement.
If you're drawn to these numbers and you didn't know this as a dividend investor, you can join our Everything Money community below. You get access to the data behind Paul. Paul, you made this data, you made this website because people were just asking. We used to use Y charts in our videos a year ago, and people said, how do I get Y charts?
Y charts is $200 to $500 a month.
So sure enough, you had the grand idea to just make our own app in the palm of your hand. It can be there. Go ahead, tell them about it, Paul.
It costs a buttload of money, but guys, it was well worth it. Look, guys, we have a mobile app. Everything I showed you is on your mobile phone. 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content, access to all of us. Watch our other videos. You'll see more about the software. You get all of this for 90 cents per day, all the way down the list. Less than a crappy cup of coffee. If you are serious about it, which you obviously are because you're watching YouTube videos about finance and savings and investing, if you're serious, this is a no-brainer. Our competitors are $200, $235 a month. And as you can tell, you don't get everything we give. It's a no-brainer. Do it. You're here watching a video for the reason.
You're at the right channel. We do more videos than all the other channels out there. We get a ton more subscribers than all the other channels on a daily basis, even the ones that are 10, 20 times bigger than us. And you can join Mo in the morning at 9 a.m. for stock news and trading analysis.
Yep.
We go live every Tuesday at 2 p.m. to the world. Bring your questions and we will answer them. That's our take on dividends. Stay tuned, watch more videos, and we'll welcome you into our community. Thanks for watching. And tickle that thumbs up, you know.